Let me ask you something uncomfortable. A few hours before I recorded this, Robinhood, a platform with millions of everyday users, made Chainlink the official oracle powering its brand new stock tokens, live on day one. And Link? It's still sitting at $7, on the most oversold reading in its entire history. The crowd is calling this token dead. And yet the same protocol behind it quietly bought over 500,000 Link last month. So today I'll show you the exact gap between what the price is screaming and what the network is actually doing, and where I'm placing my capital because of it. The mood around Link is heavy. Boring, slow, scary, pick your word. Price is under every major moving average, and the ETF money that flooded in last winter has thinned out to a trickle. That's the surface. But market structure is rarely about how a chart feels. It's about who's accumulating while everyone else looks away. I've covered Chainlink more than 10 times on this channel, so this is definitely not hype. It's a thesis I keep pressure testing. And the widest gap I've ever seen between fundamentals and price is sitting in front of us right now. Let me walk you through the network first, because the numbers there tell a very different story than the candles. Start with the Chainlink Reserve. In June alone, it accumulated 593,000 Link, worth over $4.5 million, pushing total holdings past 4.5 million tokens. This matters because it's not sentiment buying. It's programmatic, funded by real network revenue, converting fees into Link on a schedule that doesn't care how you feel. Now connect that to the build program. Chainlink Labs is winding down token rewards, with the last claims ending July 7th. On the surface, a program ending sounds bearish. Look closer. They're cutting off a stream of partner tokens that used to hit the market, and rerouting that value into Link-denominated agreements. That's dilution getting switched off, right as the reserve switches on. Whale Logic sees this instantly. Retail reads a headline and moves on. Then there's the revenue itself. Over the trailing year, the protocol generated $52.5 million, and the most recent week alone printed just over $1 million from cross-chain fees and payment distributions. That's a real run rate, climbing, and the price chart hasn't reflected a cent of it. Layer on the newer revenue engine, SVR, which recaptures value during liquidations. It's pulled back over $21 million that used to leak to searchers, with roughly $7 million of that flowing to Chainlink, and Aave's share just hit one of its highest months ever. Here's the subtle part. That stream scales when markets get violent, not when they're calm. So the protocol quietly earns more during the exact fear we're living through. Now the institutional layer, and this is where it gets loud. Start with the one that landed just hours before I hit record. Robinhood made Chainlink the official data and cross-chain oracle for its new Robinhood chain, powering its stock tokens from day one. Think about what that means. A mainstream brokerage with millions of everyday users just put Chainlink under the hood of real-world assets that ordinary people already trade, through CCIP, data feeds, and data streams. That's the kind of distribution most crypto projects never get anywhere near. And it's not alone. Project Pangea brings together more than 50 banks, representing over $10 trillion in assets, using Chainlink rails to settle cross-border forex in real time instead of the old 2-day cycle. APAC equity streams just went live, putting names like Samsung, Sony, and Toyota on-chain, with more markets queued behind them. Another partner, ARK, joined the Scale program the same week. And across the whole Oracle sector, Chainlink still commands almost 59% of total value secured, nearly $29 billion, spread across more than 500 protocols. The nearest competitor, Chronicle, has a fraction of that reach. And underneath all of it, the base keeps widening. Unique wallets holding Link just hit an all-time high, almost 900,000 addresses, growing while the price bleeds. And here's the data that answers the oldest knock on this token. The bear case was always the same. Nice network, but you don't really need the Link token to use it. Then the Bank for International Settlements, basically the central bank for central banks, published research on how stablecoins actually move on-chain. Their finding? Link was the 5th most co-used token in USDC and Tether transactions, and 6th in PayPal's stablecoin. When real money moves through the biggest stablecoins, Chainlink is right there inside the transaction. And as that volume climbs, so does the reliance on it. And for anyone who cares about yield, Link liquidity pools are still paying real returns. So the token isn't just sitting there. It works if you know where to look. But here's the contrast I can't ignore. While every one of those catalysts points up, the ETF flows point down. Monthly net inflows have collapsed from $59 million back in December to under $4 million in June. That's roughly a 90% fade. So one side of this token is accumulating relentlessly, while the institutional flow everyone was counting on walks out the door. Robinhood can hand this network millions of users overnight, and the ETF desks can still sell into that same week. Both are true at once. Which force wins? That tension is the entire trade, and the chart is where it resolves. So let me break down the technicals because the pattern here is textbook, and it's testing my patience on purpose. Zoom out to the weekly. Price sits below the 21 and 55 exponential moving averages, and below the 200 simple moving average, the green line that acts as the long-term trend divider. Being under all three is objectively weak. No sugarcoating that. Back in April, Link broke above the descending trend line drawn from that $26 top in August of 2025. For a moment, it looked like the reversal. Then it rejected right at the 21 EMA, flipped that former support into resistance, and slid back down along the same trend line it just escaped. Now we're pressed against the February lows, sitting on the 1618 Fibonacci extension near $7. Here's the map. Immediate resistance is $8, the support we just lost, and above that, $11, the last real rejection zone. To the downside, if a weekly candle closes below this level, $5.55 becomes the magnet. That was the floor of the last bear market from 2022 into 2023, and price has a long memory for those. So the range is defined: 7 on the edge, 5.5 below, 11 above. Now the indicator that actually has my attention. The Heikin-Ashi Relative Strength Index at the bottom of the chart hit the most oversold reading in Chainlink's history back in February. And right now, something quiet is happening. Price is carving a lower low, but the indicator is printing a higher low. That's a bullish divergence, momentum refusing to confirm the new price weakness. I've marked those white circles on both the price and the indicator, and every one of them lined up with a great accumulation window before a real move higher. We are sitting in that exact scenario again, in the middle of a genuinely ugly crypto tape. So here's my strategy, plainly. My load zone is $7 to $10, and I'm treating this as a long-term position, not a swing. I buy oversold, I de-risk into overbought. And right now we're back at the low end of my zone for the second time. In my honest opinion, this isn't where you sell. My upside targets, if this plays out, sit at $11.60, then 15, 20, 26, and 34. The 0618 retracement near $15 is the first real proof the trend has shifted. What keeps me honest is the downside. If Bitcoin cracks lower and drags Link under 5.5, this thesis needs a rethink, and I'd look to reaccumulate, not chase. I'm being real with you. This could also grind sideways for months, a ping pong between roughly $5 and $9, just like the last cycle bottom. Boring is a real outcome. That's the game plan, risk versus reward. Put the two halves together. Fundamentally, this is one of the strongest networks in the entire sector, accumulating its own token, earning real revenue, and pulling in $10 trillion institutions. Technically, it's oversold, below its trend, and flashing the same divergence that marked past bottoms. Best case, the ETF flows are simply lagging, and they catch up to the enterprise story that's already built, a story that now has Robinhood's name stamped on it. Worst case, the market is right that these banking deals monetize over years, not quarters, and price stays heavy while we wait. The probability I lean toward is accumulation into strength that hasn't priced in yet, but I hold that view loosely. What flips me bearish is a decisive weekly close under 5.5, on rising volume, with the divergence broken. Until then, the structure says patience, not panic. Now, let me bring it home. 3 things. Chainlink is oversold on its most extreme historical reading. The network is buying itself while mainstream names like Robinhood quietly plug in, and the biggest risk isn't collapse, It's boredom. My honest wisdom after watching this token for years is simple. The best entries never feel good. They feel exactly like this. If this breakdown saved you some time and sharpened your thinking, hit like and subscribe. It genuinely helps the channel keep going. And if you want to see the exact percentage Link holds in my portfolio, my live buy and sell zones, my Sunday prep report, and the weekly strategy calls where we walk through this in real time, that lives inside the Pro Capital Vault, my private Discord, which you unlock through the members button below the video. Join, then just sync your YouTube account to Discord and everything opens up. It's not a sales pitch, it's an invitation to sit on the same side of the table as me while this plays out. This is my analysis, not financial advice, so always do your own research before you act. And if you haven't seen my last Chainlink video, watch that next because this one picks up right where it left off. Much love, and I'll see you in the next one.